All right, guys, welcome back to Lines of Forex. This is Kishore speaking. Trader here. I send signals daily and I do webinars here, so I'm glad you can make it. Welcome, Carl. Welcome. As I was saying, right, today we'll be covering quarterly figures, right? Let me just share my screen. We're going to be doing this off of my screen. All right, let's see here. All right, welcome. Everybody who's just joining us, my name is Keisha, and I'm a trader here at Loft. And I send signals and do webinars daily, right? So today we're going to be doing quarterly figures, right? I already did this webinar a couple weeks ago, but a lot of people was not, the people that's here now probably wasn't here when I did it. So I'm going to do it again because it's a very important aspect of trading if you intend to be an independent trader and you intend to be trading, doing your own analysis. It's going to help out a lot, adding to your confluences, right? So what I have up on the screen here, if you can see my screen, just drop a message in the chat and you can hear me clearly. Drop a message in the chat, right? So right now on my screen is a USD CAD trade I sent out a few days ago. Currently at 19 pips. Took this trade on the daily time frame, so obviously we gotta be patient with it. Actually been in and out of profit for 3 days, but we're holding, right? So let's get to the topic. Let's see. We're gonna use GBP JPY for this, and probably gold, right? So here is the idea, right? Quarterly figures is simply a confluence we use in the market to increase our probability when finding the right entry, right? So I usually call it QF for short, right? Stands for quarterly figures. So sometimes if I send in a chat, you would see a line and the line would mark for QF, then you know that it's a quarterly figure, right? Quarterly figures are basically half numbers and quarter numbers, right? So you gotta think about it as a dollar. You got $1, you got 25 cents, you got 50 cents, you got 75 cents, right? So it's the same thing on the chart. It's the same thing with the different price levels, right? So the numbers can range depending on which time frame you're using, right? So right here, let me just remove this setup. Right here, I've already got it marked out on a lower time frame. So basically, these lines that I have marked up here are the quarterly levels, right? We have 130.500. So that's like 139 and a half. We have 139.75, and then we have 130, right? Now, the reason why we pay attention to these numbers is because whenever a bank or a large institution is placing a trade, they would usually place the entries at these numbers, right? Simply because it's easier for them to calculate when they're entering the market with these numbers. So let's say I'm a bank and I'm about to buy BPJPY. I'm about to place an order for 1,000,000 lots. Um, it's easier to place that order and have a target that is a round number. So instead of taking it at 140, no, 139, 8, this number here, 139, 139, 893, right? It would be extra work to calculate the profit and the loss, the exact number. So usually they would just buy and sell at the whole numbers. So the distance from 140 to 140, the distance from 140 to 141 would be 100 pips, right? The distance from 140 to 142.5 would be 25 pips, right? And we know the market tends to move in 100 pip ranges, if you haven't realized, right? So I have these levels already marked out on the chart, right? This is on the 4-hour time frame, so this is more for like a sniper entry, right? Low risk entry. So the idea is we expect the market to react off of these institutional levels because we know that's where the money is, right? All of these levels are drawn in, and if we look closely, we see that they're acting precisely to those levels, right? Now, before I go into it, I'm going to just tap on the line chart. The line chart shows the true movement of the price with no manipulation, right? Candlestick charts can show manipulation because when the candle shoots up and comes back down very quickly, that can be manipulation from a bank just trying to knock out your stop losses or or whatever market maker is participating in the market, right? But if you go on a line chart, you would see the true movement of the price, right? So on the line chart, we can see the market reacting to all levels, right? These levels can be used as support and resistance. So if we highlight this level here, you can see we have 3 bounces off that level. Not all the time the market is going to hit the level T. You're just going to have to draw out a zone, maybe like a 5 or 10 pip zone, right? So we're just going to observe and see how the market actually reacts to these levels, right? On the line chart, right? This is 141, 250, 141, 140, 75, all right? You can see that the market came near this zone. And this is just a consolidation area that I marked out to see how the market reacts to the levels, right? So obviously we can see that there is a reaction, that I'm not just talking nonsense, and there is a pattern here. There is a pattern because we can see the market reacting to these levels, right? So let me just hop on to the candlestick chart and let's see if it also reacts. Let's see if, let's see, okay. I'm gonna draw out the 41,500 level, right? Okay, so we'll start from the top and then we'll come down, right? Hmm. Audio. I actually don't have a microphone. I'm just recording this off my computer. How's everyone's audio quality? Can you hear me clearly? Okay, I'll continue in the meantime, right? So let's start here. We can see the market reacting off of 141,500, right? We can see the market reacting off of 141,250, right? We can see the market came up, played around the 141 level. The market came up, tapped the 140.75 level two times, came near this time, shot past these two times over here and closed beneath, right? You can see the market reacted off of the 140.500 level, right? All these levels are spaced out by 25 pips, right? That's because we're in the smaller time frame, the 4 hour time frame. You can draw levels on the daily time frame. That's gonna be 500. That's gonna be 100 pips apart. You gotta, depending on what time frame you're using, that's the levels you're gonna be drawing, right? Now, if I hopped on the daily time frame, these levels would be too close. It would look It would look messy. So we would probably take just the whole number levels, right? Or the half numbers. The lower time frame, you can take the quarter numbers, the half numbers, and the whole numbers. But as you go up the time frames, you would probably just take the whole numbers and the half numbers, and then you would probably just take the whole numbers, right? So there's a lot of movement in here, but we can still see some wick reactions. If you're a scalper, you can take advantage of this, right? And then we have reaction of 39.75. Couple reactions actually. And we can see we have reactions off of the one 39.50, right? Now, when I just set up this chart, I had a setup that looked like this, right? Stop loss above this level. Basically, this was a setup that was taken about 3 times, right? Basically, when the market dropped, I expected it to come up to the 140.75. Trade solely based off of quarterly figures and a few other confluences. And my stop loss was above the next level, right? Basically, the market came up, came up, and then dropped 95 pips, came up for a separate trade, dropped let's see, dropped 130 pips, and now it came up again, all right, and dropped 21 pips. Now the reason why, right, I paid special attention to this level is because I can see that yes, it's a quarterly figure, right? However, it's also resistance. And this quarterly figure in particular seemed to be very strong. It seemed like the banks love that level because one, the reaction I would get from it. You pay attention to the reaction, how fast the price moves away from a level, right? And how much does it move away? So we just measure this, right? This was the first reaction. The price dropped. Actually, let me get the measure out here. From the first reaction, the price dropped 184 pips, right? In, let's see, 184 pips in 8 hours, right? That was the first reaction. The price dropped 188 pips in 8 hours, right? That's telling me that there's a lot of money on that level to cause that reaction, right? And then the price came up, couldn't tap it, came near, probably dropped 100 pips. Let's see. Yep, 100 pips. Price came up again, right? And then dropped 128 pips, right? So now I know the market is in consolidation, right? I know that the consolidation is mostly between 175 and 139,500, right? So when the market shot up and came back down into this consolidation zone, I paid attention to the 140.75 level because I know that there's a lot of money there to be causing all these reactions, right? And then when the price broke under, came up, when it broke under the first time, came up, I could have entered my trade here, 25 pips stop loss, because these levels are 25 pips apart, right? And we can see that we have 3 lovely reactions, right? So also we could have done it this way as well. Look at the 139,500, right? You could see the market keep bouncing up, and this level was very strong, right? That quarterly level in particular. If you didn't enter the first time, the second time, the third time, you even had a chance to enter, right? Obviously, stop loss would have been below the next level, 25 pips away, right? At 139.25. Just label this. And that's just a simple way you can place trades using quarterly figures. Now, as a trader, you don't use this confluence alone. You use this and align it with at least 3 or 4 more, right? Just to find those high probability setups, right? So if, let's say you want to be a trader, I'm guessing everyone in this chat wants to be a trader. They want to trade independently, right? You should now take it upon yourself, when this webinar ends, take it upon yourself to go on your selected pair and draw out those quarterly levels and see how the market reacts to it, right? And when you see how the market reacts, if it does or if it doesn't, take a screenshot and drop it in the chat, right? I'm gonna tell you if it's right or if it's wrong. At least that way it's easier for you to remember. You would have practiced it and you would have seen that it actually works, right? So let's hop on the high time frame, daily, and let's punch in some quick levels and see some higher time frame levels and see if we get any reactions, right? So let's punch in, and you can see I actually placed my level so that it's not visible on the higher time frame, right? Because I like to keep my charts clean. So it's only when I go on the lower time frame to get a sniper entry, I'll see these levels, right? So we're gonna punch in coordinates 139. We're just gonna do whole numbers. 138. 142. 141. 140. 140. There we go. Let's go to 140. These are all 100 pips zones, right? Okay, so let me tell you, this works really well with gold. It works well with oil. It works well with the major pairs, right? Euro USD, GBP USD, USD JPY, USD CAD. Try them, okay? And if this stuck with you, let me know. I don't think I'll have to do this again for the guys that's in here. You know, I think I broke it down pretty simply for you guys to understand, and I appreciate you staying here and learning this conference with me. All right. So I still got a couple more to do. I'm gonna do it throughout the next few weeks and the next few days, but quarterly figures, I think we got this down for the guys that hopped on the webinar. All right. So I'm gonna stop it here. Gonna wish you guys the best trading for the few weeks to come. Look out for those fire signals, and I'll be in touch. All right. So I'm gonna end this here, and thank you for coming out to Lines of Forex. You want me to do your USD? You want me to go over your USD real quick? I'll do that. Okay, so you see, I got this marked out, right? This is a trade I think I sent out to F1 1075, right? And then we got another one here, right? And you can see the market did react. Reacted here, reacted here, reacted here, reacted here, reacted here. But I'm gonna hop onto a different Euro USD broker chart because I already have this marked up and see how it reacts. This one I was just marking off some channels as conference as well. Okay, so let's punch in some higher time frame some higher time frame levels. 110,500, 111. I'm punching the halves on the figures. 110, 111, 5, right? 12, 10, 1, 9, 5. And let's do another one. 1, 8. That's too low. Let's do 1, 9. Okay, so we got our levels marked off. Let's see if the market has been reacting. All right, we'll start from the bottom. Daily time frame. Remember, the daily time frame requires more space, right? But you can see we had some buys at this level, right? Reaction, all right? Reaction, all right? Reaction. Usually we just expect like a wick to shoot past or shoot near the level and we get a reaction, right? So these, let's see. This one reacted off the quarterly. So this one reacted off 111.75, right? I think this reacted off the same thing. So like I said before, right? Quarterly figures are great. They're even better if you use them with some other confluences. If we scroll back, we can see some reactions, right? So like I said, hop on your own charts, do this, send a screenshot, I'll review it, and include this in your analysis. Okay, any other questions, guys? All right, thank you for coming out. I'll send you some great trades this week. Look out for them. I usually send them around 7, 8 Eastern time. Have a good day, guys.